Good afternoon, traders and investors. Will back here with another one, coming to it a Friday market recap. Hope all of you had a very nice week of trading. And in today's markets, guys, well, the bulls continue marching on to new all-time highs on the SPY and the QQQs as well. Although the SPY was a little bit muted, most of the action was once again a little bit top-heavy, the performance largely coming from big tech, leading to the QQQs being up almost 1% on the day, ending at about 0.89. So, a lot of the price action today, guys, was helped by some very favorable jobs data this morning, and some very favorable wage growth for the consumer as well. Consumer sentiment also receiving a little bit of an uptick. And from those news releases onwards, the bulls just kind of didn't stop and just continued marching forward for a majority of the day, especially into big tech. So hopefully all of you were able to benefit from a few of those rallies. In terms of myself, well, the portfolio right now is currently sitting at a very cool 80.65% in terms of the last year of trading, looking very good there. And pretty much no stranger to this on the channel, guys. We wrapped up last year arguably the same. This is a video from last year, 11 months ago, recapping the end of the year. And you can see on screen the performance. There was a few days left of trade, admittedly, but we had about 73, 74, 75% by the end of the year. And that was pretty much the performance for 2023. So this year, another good year running mostly the wheel strategy. And you can see some of the dips that are had in the portfolio right above my head in June and later on in July and August. What are those dips? They were all shown publicly on the channel. Those were earnings plays gone wrong, mostly in terms of retail sector plays, Nike, Starbucks, all coming down to the downside, right? I lost another one on Pinduoduo, one on CRM, and one on Disney, I believe, as well. And all of those severely kind of hindered the growth of the portfolio for the, the middle point of the year, but we were able to quickly recover from those losses. Good thing for that, in terms of just being consistent with the strategy. But this is once again a testament, guys. Do not do what I do sometimes, which is play earnings. I always say this on the channel. Do not play earnings, because if you're not in the ability to cut the losses quickly and just maintain a cool head and just persist with the strategy, you can end up with some outsized losses. And if you're not quite sure how to recover from them, it could be a very bad time. Moving forward, you're going to see a lot less earnings plays from me, because as I always say, it is a heck of a casino. But all in all, it's been a very good year so far. Can't complain. We are very blessed here. And in terms of the weekly performance, well, here it is from the Discord. 10 trades on the wheel strategy. All 10 of them wins. Some very nice premium generation this week. A few directional trade wins and some earnings and even lottery play wins as well. This is going to wrap up pretty much all of my plays for earnings this year. So it's been a very decent year so far. Now, in terms of today's video, guys, we're going to tackle a few things together. Number one, we're going to go through a little bit of the data that came out this morning, recap the numbers, and see where we stand in terms of the health of the consumer. Thereafter, I have a few earnings releases prepared for you guys. We're gonna do 3, not 4. We're gonna do Chewy, Dollar General, and Lululemon. Ulta Beauty, I'll probably cover them on the Monday. Maybe I can include one more out of this bunch that I didn't cover this week on the Monday session. But for today, Chewy, Dollar General, and Lululemon as a whole. Gonna also take a look at the health of the consumer as measured by some of these retail-facing stocks. Thereafter, of course, we're gonna go through a full sector analysis, every single minor sector in the S&P, see how those are standing up in terms of sector rotation, because I always say, pay attention to the rotation and you will be able to follow the money. So we'll take a look at that, then take a look at crypto, of course, take a look at our big tech names, a few of the high flying names such as SoFi, some of the ones that have come down recently like Uber, stuff like that. And then to wrap it all off, I will give you guys a full portfolio rundown of the trades made this week and what I have remaining in the portfolio coming into next week as well. So a lot to cover in today's video, guys. I'll do this one as quickly as possible, but there is a lot to cover. So if you ever need to navigate throughout the video, just keep in mind there is timestamps down below in the description to get to the part that you prefer the most. So let's get right into it. SPY up 0.19%, QQQ up a nice 0.9%. But all in all, guys, once again, it's been a very top-heavy market this week. We've been saying this all week. Once again, most of the outperformance coming from big tech, everybody except really for NVIDIA and a lot of other semiconductors, AVGO doing well. Financials, a little bit of a bounce day, but it was not broad market-based in terms of financials. Healthcare continues to be a very mixed sector, and the bottom half of the market still struggling. And this has been the case roughly for the last week of trade. Most of the performance has come from big tech. If you put this on the 1 week relative, you can see even better here. Here's your 1 week performance. Very top heavy market. But then again, the bottom half of the market was doing a lot of the heavy lifting before this week. We needed some participation by big tech, and they have finally shown up. But unfortunately, the rest of the market now taking a little bit of a breather after the bottom half was supporting us pretty much from the October through, well, let's call it October through just about a week or 2 weeks after the election cycle. The bottom half was outperforming, and big tech for the most part was fairly muted. Now, big tech largely coming alive, so love to see that sector rotation coming into play once again. Take a look at the 1 day relative. You'll see that it's a very top-heavy last week of trading. Consumer cyclical, communication services, and technology to the upside. Everything else largely down, led to the downside by energy. On the 1 week relative, pretty much exactly what the heat map was showing. Basically, only tech and consumer cyclicals, and the rest of everything taking a well-deserved breather. On the 1 month, however, we still remain a fairly balanced market with most of your major sectors outperforming to the upside. So that is pretty much for in terms of the heat map rundown. Now, before we get into more technicals, let's go over a few of the data releases this week. Why was the market so bullish? Well, I'll remind you what we got this week. Every single one of the catalysts came in largely in line with expectations. Starting off with the manufacturing index, if that would have been bad, guys, that would have caused a August slowdown period in the markets as well. We got a good report. The JOLTS job openings report was heavily watched too. That was better than the expectation. ADP employment came in slightly under, but roughly in line. It wasn't a big miss. So once again, that was not a negative catalyst for the markets. And then today we got the big one, guys. So take a look at this. Average hourly earnings month over month, 0.4, better than the consensus of 0.3, and average hourly earnings 4% better than the 3.9 expectation. This is year over year. One thing you should notice about these numbers, guys, average hourly earnings year over year increasing 4%. What is that higher than? It is higher than the rate of inflation currently. So consumers are, however slowly, regaining purchasing power against the inflation that's been had in the economy over the last 1.5 years. Now, I agree, it's a very slow process. You may not feel it yet, but the consumer is not being eroded by inflation at the current time. The wage growth is outpacing the rate of inflation, which shows a healthy progression in wages. Now, in terms of the non-farm payrolls, coming in 27,000 above the expectation of 200K, that was well received, and the unemployment rate staying steady at 4.2%, which is roughly around historical lows. We even got a slight bump on consumer sentiment index. We know that the consumer has not been very happy with the economy as of recently, but the sentiment is not deteriorating. If anything, it is staying the same or slightly improving. So all across the board, guys, not looking too bad. What do we have on the table for next week? Well, next week will be a fairly smooth week, if you ask me. Only CPI, and CPI is not supposed to be that bad, guys. We're supposed to get a 2.7 read, slightly above the 2.6. Now, it's not that big of a change. It is up ever so slightly, but it goes in line with Jerome Powell's comments of it's a bumpy path down to 2%. The one thing that you don't want to see is inflation skyrocketing, and as of right now, it really isn't. So there you go, year over year 2.7. Compare that with the wage growth, and you can see the wage growth for consumers is outpacing the year-over-year rate of inflation. So we are regaining purchasing power. I know it doesn't feel like it. I know it feels slow, but it is actually happening right now. So that is the case for the financial data releases. Now, before we once again get into more technicals, guys, let us dive into our earnings. And I'll cover these as quickly as possible. We're not really going to deep dive these because a lot of these companies we've done before and we know the problems. So I'll summarize the problems, what the companies are facing, and then we'll dive into the numbers and valuation. So number one is going to be Chewy. So Chewy had their earnings just a few short days ago. The company wasn't looking too bad. They had an initial drop of about 9% before recapturing everything, but now they have been trending lower over the past few days. They did miss on EPS here by 82%, but then again, their EPS is measured by cents, guys. They're on the verge of becoming EPS profitable on a consistent basis. Revenue came in roughly in line, slightly beating the expectation. I will remind you in terms of the EPS number, you just got to look here, right? The company doesn't really have the best margins right now, but keep in mind, they are coming from negative net margins and coming off negative EPS. So the company has now been profitable for a few quarters in a row, and you can see the EPS has flipped since 2023 all the way through 2027 will be positive and expanding. So the company is doing very well in that respect, and revenue continues to expand at a very nice pace. That being said, let's take a look at some of the highlights from their earnings, shall we? In terms of the highlights, guys, 160K sequential net active customer adds. That's very good. And they are, with the new free cash flow and the positive net margins, they are starting to buy back shares. 875 million was returned to shareholders over the course of the year, Financial metrics, 80% of the customer sales as a percentage of net sales are what they call auto ship. That is subscription services. Let's say you have a dog and you want to always buy the same dog food once every month, a big bag of dog food, right? Well, there's two ways of doing that. You can either manually go into chewy.com and buy it every single month, or you can do what Amazon likes to do as well, which is the subscribe and save option, whereby it just ships you a new bag. You can get a 5% discount for putting it on auto renew, and that's how it goes. You can see that it's very popular among customers. 80%. This is very good for customer retention and building customer loyalty, guys. Very, very, very good indeed. 4.8% margin on EBITDA as well, which is pretty good. Look at the net sales, guys. Net sales are going up pretty much in the last 12 months, very much higher than 2023, 22, and 2021. That's good. Quarterly increases quarter over quarter. Although slow, it is increasing. Very good. And here's your auto ship customer sales. You can see very nice progression, both on an annualized basis and a quarterly basis as well, growing at about an 8.7% clip. Net sales per active customer has also been trending higher. So not only are they gaining more people, but the people that they do gain tend to be spending more and more on the platform. Gross margin, you can also see some very nice improvements here, although it's not leaps and bounds, it is very decent. And when we take a look at Chewy's profit margins, you'll see, as I showed, well, you'll see, I just showed it to you right on the trading view graph. They are expanding margins. The margins aren't the best, right? But they are coming into the positive territory, which is what you want to see from a growing company that was struggling with negative net margins in the past. Increasing EBITDA as well, which is very good. This is earnings before interest, taxes, and depreciation, also known as pre-net earnings, if you will, right? And then free cash flow as well. This is one of the very big highlights of the company. Look how much they've expanded free cash flow since 2021. Very good. And what are they doing with that free cash flow? They are buying back shares. So returning a lot to the shareholder in terms of that. Net sales will be approximately 13% year over year for the fiscal fourth quarter, and total for the fiscal year, about 6% year over year growth. Now, it's still not amazing. We're not talking about growing revenue at 20% clips. But then again, the consumer is being very picky right now, and Chewy has acknowledged the macroeconomic backdrop that it's facing. I think that it's navigating the landscape quite well, and they're finishing here with a cash balance of $508 million, which leads us to the following analysis. When we take a look at their balance sheet as well, right, in terms of, does the company have too much debt even though they're growing well? Well, as a matter of fact, no, the company is actually positioned quite well. We just got the update, right? They have about $508 million in cash. So you can see right here, fantastic free cash flow generation currently, decent amount of cash on the balance sheet, and not that much debt. So the company's positioning is fairly well. And we already took a look at the growth expansion, but I'll show it again, guys. Analyst price targets up here, roughly 36 to 40, not too ambitious on the price targets. And EPS will be decently positive moving forward, and revenue continues to expand very, very nicely. So overall, guys, Chewy looking very, very strong. Nothing bad to say about the company at all. And as we can see, I wrote down some of the highlights here from their earnings presentation that I didn't go over, right? So we still have a bit of a pet adoption decline versus the pandemic boom. That's very normal. A lot of people got pets during the pandemic, and we're just not seeing the same adoption rates. Pricing power has also somewhat peaked. They have not done any price increases in 2024 as they battle with customer retention. They don't want to increase prices too much and force people to shop somewhere else, right? So they want to retain their customers. This is completely normal, guys. A lot of retail-facing companies are facing this issue right now, but Chewy is dealing with it fairly well and expanding margins as well. They also have the, Canada expansion, slightly declining / flat active user growth. This is true. We saw it in the slides, but I do think the company guides as well that it will be getting better in 25 and 26 as consumers once again unlock more of that purchasing power that they've lost over the last few years because of high rates and high inflation. They also have a nice Canada expansion. They're expanding. That is an extra $10 billion in total addressable market. Looking very good there. I have not used the service myself, but would be curious to try it. It's already active here. I haven't tried it yet, so I guess that's on me. But they have expanded into Canada, and they're also doing veterinary expansion as well. This is a $25 billion total addressable market, and could give them some very decent, service revenue as well in terms of those vet fees, right? We know that vets are very pricey, but if I know Chewy, they'll try to keep it as low cost as possible and attract the most amount of customers as possible. So they're expanding into veterinary services as well. Could be quite decent. They've started that in the US, but not Canada just yet. Low debt, free cash flow positive, plus growing, plus buybacks, low share dilution, but they still need to control their operating expenses because their margins are not so large. So the revenue growth is 11% per year. I didn't do a PEG ratio, guys, just because the EPS growth is a little bit tricky, right? Because they have an up year in 24, down in 25, and then the up thereafter, right? So you can do a PEG ratio after and get something decent, but I focus on price to sales, right? So their forward PE is about a 40.1, but when we measure with an EPS 25 onwards, the PEG ratio is actually not too bad, guys. It's about a 1.2, 1.3. Should have put it on screen. What I like the best, though, is the price to sales. This company is currently worth only $12 billion in market cap, and look how much sales they're generating on a yearly basis. 11, and then next year should be about 12 as well. The price to sales is sitting around 1. That is very, very decent for a company of Chewy's nature. Dare I say, slightly undervalued. So I can expect some expansion possibly into the 40-45 region right there. So in terms of a long-term portfolio play, not really for me. I like to have more monopolistic companies in my portfolio, but there's nothing wrong with Chewy as a company, right? If anything, there may just be a swing trade from here, even into the low 30s if they come back there, all the way up into the mid $40 range, which is these guys up here. So I like this company. There could be some decent upside to be had. You know, that doesn't sound like much, but that is 50% possible appreciation for not that much risk to the downside because the fundamentals do support the valuation expansion, at least a little bit, especially when measured to price to sales. So all in all, guys, very happy with Chewy's performance. Nothing bad to say about the company, and there could be a decent trade opportunity. For myself, I will continue to play it. If we get some opportunities to the downside, I'll continue to write short puts. And if I get assigned, this is a company that I really do not mind being assigned on because they do have very nice expanding fundamentals. So that's everything for Chewy as a company. Hopefully you guys appreciated that one. Now let's move into company number 2. And this one is definitely a problem, guys. A problem child of the market, right? Dollar General, the fall from grace of Dollar General. Everybody knows this. Their sector peer as well, Dollar Tree, has faced largely the same, decline curve in terms of price. But for now, we're going to take a look at Dollar General's earnings and see whether or not they're able to salvage their business. So we know the problems with Dollar General before were a lot, right? They had a lot of inventory buildup, increased promos, absolutely killed margin, same-store sales slump from 2021 and 2022, and store theft. What do I mean by same-store sales slump? Well, you'll see it right here, right? Take a look at this massive drop-off in EPS from 21 and 2022, and then they're just losing customers. Now, they blame it on discretionary purchases, right? Saying that the consumer has less money. But then again, in prior periods of economic difficult times, usually people go shopping to the dollar stores more. So there's something that we're missing right here. And I do believe I've touched upon this in the past, but we will touch upon it again. What happened to dollar stores, to Dollar General's margins, and what happened to their revenue as well? Where have their customers gone? Well, here you go, guys. Dollar stores are struggling to win over bargain hunters. Here's why. I won't go through this whole article, but we're going to highlight some points right here, guys. You'll see it's a mix of different things, but they're losing customers mostly to competition. There was a business model shift that happened during the pandemic. Can you guys guess what it is? It is the shift to online shopping, something that the dollar stores have not been doing too well at all. Razor-thin operating models, such as lean staffing and low hourly pay. Also, this is factor number 2. Online sales is number 1. This is factor 2. Razor-thin operating models in terms of margins, such as lean staffing and low hourly pay, contributed to sloppy aisles and a poor customer experience. Competition grew fiercer as legacy retailers such as Walmart made significant investments in e-commerce to keep up with consumers' changing habits during the pandemic. Dollar stores inherently are sort of convenient because they have a lot of locations, but they don't have very strong digital offerings. And I think that's become a disadvantage in the current environment. And there you go. There's the current landscape for Dollar Tree and Dollar General. Now, moving on further, stretched shoppers, we talked about this as well, guys, right? Well, dollar stores offer a number of products, but where do they make the most margin? It's not on the bags of chips and the bottles of Coca-Cola and Pepsi, right? It is on discretionary items, such as articles of clothing, toys, and all the miscellaneous trinkets that they sell for, $2-3 that they get for like 25 cents. It's not on the chips, it's not on the food, because they get very thin margins on those products. It's just consumers are not buying all those trinkets anymore. Where are they buying the trinkets? Well, I'll give you a hint, guys. It starts with Walmart, It starts with Costco, it starts with Temu, and it starts with Amazon, and it ends with them as well. Though they deployed a different strategy, both chains, talking about Dollar Store and Dollar Tree, relied on store openings to fuel growth, to fuel sales growth. Not a good strategy, guys, when brick and mortar is on the decline by continuing to do an ineffective strategy of expansion, right? Now they've been focusing more and more. So I'll close this article and we'll get into the Dollar Tree, Dollar General one specifically, right? Dollar General tests same-day delivery as discounter chases Walmart. Aha! They've now acknowledged that it's an execution risk. It's not a consumer spending risk, because we know from Walmart, Costco, and Amazon that consumers are actually very healthy. They're just picking and choosing where, not only on which items, but also in which stores they're currently spending their money. Dollar General is testing same-day deliveries to customers' homes as the deep discounter tries to fend off fiercer competition with Walmart. They've never done this before. Here's what the CEO had to say. The retailer soft launched the delivery program in September. Now it offers same-day delivery at about 75 stores. It's offered through a third-party company, which he did not name. Don't know which one that could be. We've always said here, we're going to do delivery our way when it's time, said the CEO. We believe it's time. Well, I hope it's time, right? He said the company expects it will ultimately expand the offering to thousands of stores. They acknowledged the pressure from other retailers like Walmart, Amazon, and Temu that offer convenience, being having articles shipped to your house, along with low prices. They did not think that convenience was important to the consumer, guys. They thought convenience meant opening more locations, but they did not recognize there is a shift in consumers' spending behaviors from brick and mortar to online. Where do we see that recently? The Black Friday sales, all online mostly, not so much brick and mortar. Over the past year, DG has felt the pinch from both economic challenges and its own strategy. Consumers, particularly low-income households, have pulled back on discretionary purchases because of the cumulative effect of high inflation and high interest rates. DG has also paid millions of dollars in fines for sloppy stores and blocked fire exits that became both workplace safety hazards and potential turnoffs for its shoppers. This is also why, by the way, we've looked at Walmart earnings. And what did Walmart say in their past two earnings? They're modernizing all of their location, brighter lighting, newer renovations, and newer styles in their stores. Why? Because consumers care about that. There's a lot of psychological studies that are done on this, guys. When you walk into a store and the aisles are messy and the lighting is quite dim and whatnot, and there's kind of like boxes everywhere, and you only see one employee, does it give you the impression that the company is well run and well funded? Does it give you a good time as a shopping experience? No. Will you return there? Possibly not, right? But Walmart, with its brand new stores, the brand new lighting, everything's super clean and everything like that, it gives you much better impression of the store, right? So they study psychological impacts of this. Walmart spends millions of dollars, guys, studying these psychological impacts and how they translate into mathematical sales. Now, the CEO said the company launched its own program after learning from its DoorDash deliveries, which are available at about 16,000 of its stores. Customers place orders through DG's app and can get the same store prices and delivery in as little as an hour. The program also accepts digital coupons and offers cashback rewards. Aha! They're doing the loyalty programs now. Who also does this, guys? Costco, Walmart, Amazon, not so much, but get a lot of good deals with Amazon Prime, right? So if you can't beat them, you got to join them, right? And that's what they're doing. They're joining the business model. So let's look over a few of the numbers. So this is why we have to recognize these things. That's why I thought it was important for me to spend a good 5-6 minutes on this shift, clear shift in the consumer landscape since the pandemic. And the companies that do not acknowledge this shift and do not execute properly towards this shift, their business models will get left behind, such as the nature of an evolving consumer, an evolving economy as well, and the laws, of course, of capitalism, the economies of scale and whatnot. I know it sucks, but it's always been the case, guys, right? Net sales for Dollar General increased 5% over the quarter. Year over year measured. Same-store sales increased 1.3%, but that's where the bullishness stops, guys. Operating profit decreased 25.3%, which they already have very slim operating margins, guys. You do not want to see that. EPS decreased 29.4% since last year. Company announced Project Elevate initiative to expand mature store remodel program, taking a cue from Walmart here. But what does that mean? It means more heavy capital expenditure. And does Dollar General have the money to spend on remodels? Well, I'll let you guys be the judge of that. Does this look like a company that has that much money? to employ on remodeling their stores. They have a ton of debt, guys. $18 billion in debt. How much cash do they have? 500 mil. How much money do they bring in per year in free cash flow? 700 mil. Where's the cash going to come from? I hope it's not raising more debt because the company can't afford it, especially not with these net margins. Net margins are way too thin for that, guys. So this business, once again, not one that I'm looking to invest in, but we'll continue. Here's what the CEO had to say. While we continue to operate in an environment where our core customer is financially constrained, we delivered same-store sales near the top end of our expectations for the quarter. We believe our back-to-basics efforts contributed to these results as we have continued to improve our execution and the customer experience in our stores. Looking ahead, we are excited about our robust real estate plans for 2025. Robust is the key word. We believe our balance of new store growth and a significantly increased number of projects impacting our mature store base, aka renovations, will further solidify DG as an essential partner to communities in rural America. And this is true. They operate mostly in rural America, while strengthening our foundation to drive long-term sustainable growth and shareholder value. So the CEO trying to be as bullish as he can, guys, but you kind of got to read between the lines and decipher what he's saying. More capital expenditures is not good for a company with high amounts of debt and already razor-thin net margins. They're trying their best to salvage the business, but this is an execution problem that this company should have recognized not this year, years ago when it was actually happening, guys. So this is the problem, guys. You either have to innovate or get left behind, right? Get with the times or get left behind. It's very unfortunate, very, very, very unfortunate. But I mean, it's not just, it's only them, right? And I could show you a dollar store in Canada here that has learned from this and has adapted. Here is our dollar store. Do you guys see a problem with this? No, because they've adapted, they've changed, they've minimized store theft, they've modernized locations all throughout the years. And here's what you get when you have a properly run dollar store company. And this is the largest one we have in Canada. I know Canada is not as big as the US in terms of population, but here is a clear example of a company that is a well-run business despite being a dollar store, despite competing with Walmart, despite competing with Amazon, despite competing with Costco, and despite competing with Temu as well. There's ways to do this. There's ways to operate a business properly. And unfortunately, for other companies, Dollar General and Dollar Tree, they're just not getting it done. So let's go back to Dollar General right here. So as we can see, there were the problems, and even low here at $82. You might think, yeah, but Will, the stock is absolutely crushed right now. It must be a good deal. Well, honestly, guys, not really, to be honest with you. At $82 right now, the forward PE is a 14.2. You might say that's really low. Well, look at their EPS growth rate. It's trading at a 1.42 peg. The company is not even that attractive, guys. Although it is trading at under one price to sales, the market cap is $18 billion, and they do generate about $38 billion in sales. I mean, you have to pay for the growth, right? And where's the growth right now? Well, the growth in EPS is not that expansive, and the growth in revenue as well is not that expansive, right? So this, once again, is an example of what I call a value trap. And it's not my term, it's Warren Buffett, Charlie Munger, and the value investors that have come before me. This could possibly be a prime example of a value trap. Can it possibly eventually recover in the context of a overall bull market where everything goes up? Maybe, we'll see, but this one is not one for me, nor for trading, nor for a long-term investment. I think the company is just, it's a little bit too, too little, too late, as they say, for this company, right? Very unfortunate once again, but once again, it's not Walmart, Amazon, and Temu and their fault. They've adapted. Well, if Walmart didn't adapt, they'd be left behind. I mean, Target did not adapt, and they're getting left behind as well. Right? It's execution, right? Nike did not adapt. Other shoe manufacturers are doing great over the course of this year. ONON, Hoka brands, Asics, they're all doing fantastic. Nike's not, though. You know what I mean? Execution problem. Starbucks, execution problem. Other companies are doing fantastic. Look at Bros, right? Bros is doing okay. I mean, only as of recently, Bros is doing okay. Luckin Coffee in China, they're doing okay, but Starbucks is not. Execution problems, guys. You have to identify when a company has an execution problem. It's not, you can't blame it on the consumers. You can't blame it on the hurricanes. You can't blame it on anything other than your own execution. And the sooner you realize that, the better it is for your shareholders and the better it is for confidence in the brand as well. So that is everything I had to say for Dollar General. Hopefully you guys appreciated that. And now let's get into the last one, guys, which is going to be Lululemon, another company. Well, this is not an execution problem. This is a competition problem. But Lululemon, right? Lululemon up 18% after their earnings. Today only up about 16%, but they did crush their earnings, guys. They beat EPS by about 6%, and they did beat on revenue by about 1.66, right? But in my opinion, that is where the bullishness stops for this company. We've been talking about this company a lot, and I said that down here, it was a decent trade opportunity because we were so oversold on the weekly. However, I would not invest in the long term in this company, and hopefully after this next 5-6 minutes, you will understand why as well. So it is all having to do with the increased competition, guys, right? What is Lululemon's moat? Truly, I mean, they had a competitive advantage down here. This competitive advantage is what you call the first mover advantage. When you derive a product that becomes a fashion sensation, right? The leggings, when you get a trend and you're the first mover and you have the highest quality, usually people flock to you. However, when competition comes into the market, then you really get tested as a company as to how you deal with that competition, right? Are you going to be able to move forward? I am not sure that Lululemon is going to be able to generate the same numbers that they are right now in 5 years, nor in 10 years as well. So let's get into the numbers. And I hate to sound bearish because I know a lot of people must be super happy with such a big increase and say, see, I told you so. The stock has now gone up. Well, don't celebrate too soon, guys. Lululemon stock jumps as international growth helps to offset slowing US sales. And when I type in Lulu earnings, right? When I type in Lulu earnings, look at the headlines that come up, right? Look at this one. Lululemon, this is BNN, Bloomberg. Lululemon's best days may be in the past, analyst says, as the stock soars. So you see, it's not just me, guys, right? So let's take a look at Lululemon. I'll give you my opinion on this. Lululemon stock jumps as international growth helps offset slowing US sales. Keyword, slowing US sales. That's their biggest market, guys. US growth is continuing to slow, but the athletic apparel retailer is making big gains abroad, leading to a 9% increase in sales year over year. Now, the yoga pants company is pleased with the start of the holiday season. Still, on a call with analysts, the CEO took a cautious tone when discussing the company's fourth quarter outlook. While we feel good about the start of the holiday season, we still have large volume weeks in front of us. Given the shorter holiday shopping season, we continue to be thoughtful in our planning for quarter four overall. Moving forward, net income for the 3-month period that ended October 27 was $352 million. That is 14.6% net margins. Not so bad. However, you have to compare it with where they have been before. Here's where they were before. This company usually gets about 16, right? Averaging about 14 to 16%. So 14.6 is slightly under what they've been doing in the last 3 quarters. It is an increase over 2023, of course, but still slightly declining, right, guys? Not improving. The gross margins are fine, but where it counts the most, what does this mean? When the company is losing net margins, but gross is fine, it's mean they're spending more money operating the business. What do I derive from that? Sales and marketing promotions to attract customers to the stores. For the all-important holiday shopping quarter, Lulu is expecting revenue to be between 3.48 and 3.51, which is growth of 8 to 10% from the prior year. Analysts were expecting revenue of 3.5. There's your guidance, the guidance right at the midpoint. It's expecting EPS to be between 556 and 564, which is the high end of which is above the 559 analyst has expected. So slight beat on EPS guidance. So why are they up 16%, guys? Because it's just less bad than we expected. Same thing that happened to Starbucks, same thing that happened to Disney, right? Other companies that aren't reporting ridiculous growth, they're just less bad than the analyst had anticipated. So let's move on further into the article, shall we? The CFO, Megan Frank, said the company is planning the business prudently given the shortened holiday shopping season and the uncertain macro environment. They do not acknowledge competition. For the full year, Lululemon tightened its revenue guidance and raised it by just a hair. Now, Lululemon has hit a rough patch over the last year. It's still growing, but at a slower pace than it was previously, and the competitive environment has gotten more intense, growing slower than previously. What do we mean by that, guys? Well, take a look. You just got to go down here on TradingView, see forecast, take a look at this growth. EPS, doing okay, but look at the revenue, guys. Do you guys see what happened here? Here is when the trend is your friend, the fashion trend. You are the market leader. And then the competition catches up to you. And now look, they're growing, but not as aggressive as they were back here. So just pay special attention to that. There's nothing wrong with a company that hits maturity and grows more slowly, like Apple or Microsoft or whatnot, provided you have a clear moat and clear competitive advantage, which is something that I cannot say for Lululemon. Lululemon has always competed with legacy giants like Nike, Gap, Gap's Athleta, and Levi Beyond Yoga. But newer disruptors such as Vuori and Alo Yoga are also taking share from the Canadian retailer. Where are these brands? Do they have brick and mortar stores? No, they're running the Elf Beauty business model, almost 100% online, using TikTok and social media, paying influencers for paid promotions, and getting in front of a ton of eyes. And when your favorite influencers are all wearing not Lululemons, but Vuori and Aloe Yoga, you guys know what happens. The brand, the legacy brand of Lululemon starts to get eroded, and it's like it's like death by 1,000 cuts. You have many competitors, right, picking away at your market share. It's really annoying. The company has turned to China for growth, which is so far lifting sales across the overall business. Turning to China for growth, guys, I mean, I can name you a number of companies that have done that in the past. Nike, to say one, Starbucks, to say another, and it depends, right? For some businesses, it works well, like Tesla. For other businesses, it doesn't work so well. For now, apparently, it's doing okay. Behind that number is a 2% slowdown in comparable sales in the US, but a 25% increase internationally. That's very good, international increase. Overall revenue grew by 2% in the Americas during the quarter and 33% internationally. Still, the Americas remain Lululemon's largest market, and international is still a fraction of its overall revenue. So, very big growth internationally, but it's growth on very small numbers, right? It's very easy to grow $100 million into $150 million and say it's having 50% growth. It's very tough to grow $3 billion into $5 billion or $4.5 billion in the Americas and get that same 50% growth, right? So that's why you have to kind of read behind the numbers here, guys, right? And I'm sorry if I sound too bearish, but I'll explain why after. Amid its rough patch, Lululemon has turned to stock buybacks to keep Wall Street happy. It approved $1 billion increase to its stock repurchase program this month. And that is everything for the article in Lululemon, right? I will remind you, Lululemon, the valuation right now, right at $400. Down here, it was a good deal. The PEG ratio was sitting about a 1.5, 1.6, and I was saying it's cheap. It can have a decent bounce, and the bounce it did have. Right now, though, at $400, 2.82 PEG, very, very high. But you may say, yeah, but Will, you tell us not to use the PEG ratio when the company only has 10% EPS growth. That is true. So we can look at a more value-oriented metric, which is price to sales. The price to sales, guys, is a 5. The SPY trades around a price to sales of 3, and the apparel industry as a whole trades at 0.86. Here's your price to sales ratios. I'm sorry if they're a little bit small. Let me blow them up. Here is the data used as of January 2024. This is per sector. Obviously, the multiples have expanded since then because the market has gone up. If we use more it's not going to be 2x this, right? Here's price to sales for apparel, 0.86 for the whole industry, comparable against 38 different firms. Now, if you don't want to include them in apparel, even though they are apparel, you can use retail general. Retail general, 26 competitors, 1.43 price to sales. Lululemon is at a 5, right? And at a 2.82 PEG. Is there decent value here for a company that's facing increased competition and struggling in its home market of North America? It's debatable, right? So the reason that I'm sounding a little bit bearish right now, guys, is I'm trying to be as objective as possible, right? Not getting caught up in the fact that, oh my God, it's Lululemon. I gave Nike the same hard time, guys. I gave Disney the exact same hard time, even though I like the company. I gave them a very hard time. I gave Starbucks a very hard time as well. I gave Intel a very hard time as well, right? When something is not looking the best, I have to say it, guys. You have to be honest with yourselves, right? There's no reason for me putting on the bullish goggles and forgetting everything and say, yeah, for sure, this one is just going to march onto the all-time highs. No problem. Put it in your long-term portfolio. There's no risk of competition whatsoever. The fundamentals are amazing. The growth rate is increasing. Why would I do that? Not only to myself, but to you guys as well. I'd rather be honest and let you guys come to your own conclusions as to whether or not you want to invest in the stock. None of this is financial advice anyways. I'm just trying to provide some quick things, right? So fundamentally for me, not a buy because of the reasons that we've discussed. For a possible trade, I mean, the momentum is in our favor right now, but the trade was down here, right? Now we're a little bit late and we're kind of in between two levels. Where's the risk reward right now? Well, the reward is all the way up at the all-time highs. Where's the risk? The risk is coming back down into the support range. You can see the risk reward, not the best, right? It's like a 1, slightly over a 1. Up to the all-time highs. So not even the best for a swing trade right now. So for me, not really looking to swing trade it and also not looking to put it in my long-term portfolio because companies that I put in my long-term portfolio do not need to have a risk of increased competition and picking away slowly at their business model. I like to have monopolistic companies that are not disrupted by the latest fashion trends, especially not by the latest fashion trends, right? So those are my thoughts on Lululemon. And with that, wraps up all of our earnings for the day. So hopefully you guys are able to learn something from that. Sorry if I sounded a little bit too bearish on Lululemon. It's not my it's not my intention, but I kind of got to call it how it is, right? We went over the good parts, right? They are doing good internationally and whatnot. They are coming back. They've acknowledged, several things, but they have not acknowledged competition and what they stand to do against this competition, right? I hope they're not going to say the same thing as Starbucks and say, well, we offer a premium quality product. If customers like it, therefore they will come, right? No, you need to give a strategy as to what you're going to do to address said incoming competition. And so far, they have not addressed that competition, right? It's kind of like Intel, just putting the blinders on. What competition? AMD and NVIDIA are running loops around us in terms of how powerful their chips are. Put the blinders on. What competition? What do you mean our foundry business is doing bad, right? And then Pat Gelsinger steps down as CEO and says, oh, it's not my fault, right? Anyways, you guys get the drill on that. So hopefully that was clear. Now, let's dive into our technical analysis portion of the video, shall we? So moving into the technicals, guys, let me do one thing real quick. All right, sorry about that. I had to plot the moving averages because somehow I deleted them and I didn't want you guys to sit through 2 minutes of me screwing around with the moving averages. So in terms of the SPY, guys, nothing much has changed, right? We know that the bulls are in clear daily uptrend right now, getting a little bit overbought on the daily, that I will admit. The upper overhead resistance right now is sitting at the trend line about 613, 614 is the mark on that. Any single retracement, guys, is going to be looking for a higher low, anything above 584, looking for that daily higher low for possible trend continuation. Why do we have a bullish leaning bias? Well, quite simply, the bulls are in control of all the higher time frames right now, looking very good. If we do get a small form pullback over the course of maybe the next 2 weeks or something like that, just understand, even though we can roll over the daily time frame into a daily downtrend, you would still just be looking for a weekly higher low for possible further trend continuation and tons of support below us, the big one of which is down here 586 to about 584. So the SPY still looking very, very healthy. Moving on to the Qs right now, up 0.989% above the all-time highs, and the analysis stays the same as well. Beautiful daily uptrend in motion right now, and as soon as the bulls do top out, we're getting slightly overbought. Can continue for a bit more. In the event we start pulling back here, guys, need to acknowledge who's in control. The bulls. Anything above 501, just looking for a daily higher low for further trend continuation. Keep an eye here. 513 down to about 508 is going to be the next pullback area, right between the 12 and the 26 short-term moving averages. Now, we do have a bullish leaning bias, quite simply because we still control the weekly uptrends in a very big way. Let me do this properly, rather. Still control the weekly uptrends in a very big way. So even if we lose the dailies, you have to understand we have the weeklies as well, right? At this point, anything above 496, just looking for a weekly higher low for further trend continuation as a whole. So not looking too bad at all for the bulls. Very big level down here at the 12 EMA as well. And the month of December usually tends to accelerate to the upside leading into the final few weeks of the month. So we will see. We have the CPI next week, which could derail us. And then we, of course, have the interest rate decision the week of December 18th, which could also derail us. But the consensus right now is still for an interest rate cut. As a matter of fact, if you take a look at the Fed Watch tool right here, we'll probably be able to see that 85% probabilities of a 0.25 basis cut. So that being said, the QQQ is not looking too bad. Financials ending the week red, but we know that the financials index was carrying the markets higher. I've been talking about this all week since the election, right? Financials were your lead bull. QQQ until this week were not, right? They had a short-term pop 2 days after the election, and then they did nothing for a month. Healthcare also, after the election, what happened? They did absolutely nothing. No cooperation there. Semiconductors had 2 good days and then did nothing for an entire month and a half. Financials were your lead bulls, so now it's obvious that they need to take a break. And who are they taking a break into? They're taking a break into the rotation of big tech, which leads to healthy market rotation in the SPY. So financials, although they have been coming down, still looking for a daily higher low, anything above 49.20, daily higher low for possible further trend continuation. But if you roll the daily over, is it that big of a deal? No, because who's in control here of the longer term? It is the weekly bulls, looking very good. Weekly higher lows on scouting for it. 46.20 is the higher low area. So even if we roll over for a few weeks more, guys, looking for a higher low for possible further trend continuation, all while XLF is consolidating, I need to see QQQ strength, SMH strength, and at least possibly some XLV recovery as well. Need to make up for a little bit of the drop in that sector. XLV healthcare continues to be a little bit weak in the context of this weekly downtrend. And we knew we were always expecting, even with the bounce, we were expecting a lower high. However, what we have to look for here, guys, is how high was the bounce, right? And the bounce was fairly decent on the daily right there. That's one big daily move. You can see the size of the bounce was about 70% retracement. It gives the bulls a very good chance of setting into a new daily uptrend, but it does not guarantee that the bulls will be able to get it done. They have to start getting their act together if they want to transform this into a daily uptrend, because that's the higher time, that's the higher fib, but you can even do something like this, right? This is a very nice bull move up. However, in the context of this move, if you give back, it's the opposite, right? If you give back more than 61% of the move, does that show that the bulls are still strong? Or does it show a possible penchant for more bearish continuation? Well, it stands to argue if you give back 61% of the move, right? They could have stopped it right here if they really wanted to and go for the trend change. But now they're pulling back further and possibly further and further. And if you get too low here, it's very tough to then just V-shape this back up, right? So you got to keep that in mind. Healthcare, if there's anything I have to say, they need to get it done arguably right now. And now I understand that a large majority of the declines was the big declines on UNH the past 2 days, of course, because of the news of the CEO, unfortunately, being murdered in New York. But, you know, that has heavily weighed against the sector as a whole. But overall, guys, need to see XLV kind of put a stop to the bleeding right here if you want to save the possibility of this daily uptrend and possibly also the possibility for a new weekly uptrend to be established, because they're trying to do two things at the same time. On the monthly, it's not looking too bad, still controlling the monthly uptrend. In the event we come lower, we do have a lot of previous support, guys. This is resistance from 2021 and 2022 coming into support range right now. So the bulls do have a decent area to base themselves off of, but if they forfeit all of this move, guys, it'll just be all for nothing. They'll have to start this entire process all over again. So healthcare has been out of favor and can be out of favor for some time. The only play I'm in right now, guys, is NVO, and NVO is not doing too bad, but even NVO has been the recipient of a big weekly downtrend, just looking for a lower high. They have a lot of work to do, guys, to regain these higher time frames. Moving into SMH. So SMH could not keep it up, guys. Another day where they're kind of down, even though they were up 12.12% today. What are they trying to do, though? Daily downtrend, daily engulfing move. They're looking to reset this into a new daily uptrend and crack finally above our area of overhead resistance. A tale of being trapped between two support ranges, right? This resistance range, 260 down to 250, and below us, 230 down to about 220. That being said, cannot say that there's a clearly defined trend right now until they break one of these two respective zones. As of right now, the bulls are playing good defense, but they're not really going on offense just yet. For that, we need to close above 260 on a weekly time frame for me to be able to say, okay, we are going for possible weekly trend expansion into a next leg up for semiconductors. As of right now, looking a little bit muted. And when NVIDIA cannot keep it up on a day like today, well, you're not going to get that lift in the semiconductor industry. NVIDIA had decent days in the past week, but today's just coming undone. We'll tackle that a little bit later in the video as well. So SMH, still a trade that I'm watching very attentively and writing short puts under the market, not on the index, but on my favorite companies, which at the current time are TSM, AVGO, and NVIDIA, the top three performers of that index right now. Moving on to the Russell. Russell up 0.36%, but it doesn't show, does it? Red candle on a green day. Still consolidation mode, and completely normal, guys. I've pulled this chart up every single day of the week because every single day of the week, it's been the same. Financial services, industrials, healthcare have all been down. Take a look. I'll put this on the weekly just so you guys can see, right? Financials, industrials right here, and healthcare as well right above my big head. So when three of your major components of the Russell are not going up, you cannot expect the Russell to get the lift that it wants to, right? It is not only small cap tech stocks in this. This is like the S&P of small cap stocks as a whole, right? There's 2,000 companies, and here's the sector weighting of those 2,000 companies. So you need the performance of these three sectors to actually get some lift. That being said, still hunting for a daily higher low, anything above 226, looking for the daily higher low for possible further trend continuation. We will see, can they put an end to the bleeding if we get some rotation back into those other sectors. On the weekly, still not looking too bad. Weekly uptrend is still clearly in motion right now, looking as well. At the same time, even if we do continue this move down, guys, and set up for the daily downtrend, still a lot of space, anything above 226, looking for a weekly higher low for further trend continuation, and big support below us. 2020 and 2021 resistance all-time high previously, and now we got that big level as support. Going to be very tough for the bears to get back through that one, especially with this crazy November monthly candle close. So keep that in mind. Moving on to the Dow Jones right now. Dow Jones down about 0.28%. Not the worst for the Dow Jones, but still not the best looking as well, right? Looking for the daily higher low constantly. Anything at this point above 43K, looking for a daily higher low for possible trend expansion. Now, we do have a nice little tiny little area of support below the 12 EMA, above the 26. This little pocket right here, 44.3 down about 44K should do it. And even if we do roll this one over here, guys, looking for a weekly higher low, anything above 43K should be looking for that weekly higher low in the context of this beautiful weekly uptrend. So no big red flags on the Dow Jones. Let's take a look at some of the minor sectors real quick, shall we? So the minor sectors also not looking too bad here, guys, today. The minor sectors down. This is XLP, right? So your consumer staples, these guys up here, consumer defensives, right? Not looking too bad as a whole. They're going for the weekly trend expansion. Weekly downtrend was the context. Going for the new weekly uptrend expansion. Why? Because they have a very nice monthly uptrend right now. So consumer staples led by Walmart and Costco should continue to be a very decent sector leading into 2025 as consumers slowly regain that purchasing power that we were talking about earlier, right? Slowly regain down here the average hourly earnings and slowly regain confidence or sentiment in the economy enough to at least start spending a little bit more money, right? Those should be very good. Utilities right now have been down once again, but then again, the context is this very gorgeous monthly uptrend right now. It's been a rough patch for utilities. Big support below us, 77 down to 74 on the monthly. My favorite one that I'll be looking into, guys, for utilities, well, I don't really play utilities as a matter of fact, so I'll kind of save that one for the next time. AMT, American Tower Corporation, is pretty good, but still in the context of a weekly downtrend, or weekly uptrend rather, going for the weekly uptrend continuation. Pull back here, there might be some plays on utilities, but not my favorite sector as a whole. Real estate as well, down, right? Weekly downtrend, they're trying to go for the weekly uptrend reversal, but not too sure they're going to get it. May just have some more sideways consolidation in real estate as a whole. And then is also seen in my favorite real estate company, Vici, which had a great monthly performance here, July and August, but has since been retracing. But this is a breakout of a level, breakout, retest, and possibly run. You see that best on the monthly, right? Favorite real estate company in the game right now. If we come back to 31, I possibly will be adding for some swing shares. And energy continues to be weak here, guys, right? 1.7% to the downside. Look at this weekly candle close. Good for inflation, gas prices coming down, but kind of bad for the energy sector as a whole. Got to watch out here because we're coming back into support zone 91 down to about 85. Not my favorite sector, guys. Why? Because everything is working against it. Diminishing geopolitical conflicts. We know that when Trump comes into office, he wants to end all the wars in the Middle East and the war between Russia and Ukraine as well. What's that going to do to oil prices? It's going to come down. We know that OPEC has been in a global oversupply. All you have to do is type in OPEC global oversupply, and you'll see exactly what I mean. All these articles are very recent. Oil faces uphill fight as demand woes, and they have an oversupply. This one is for from challenge OPEC efforts, right? So you can see oversupply of oil, ending of the wars possibly, and oil is seasonally weak in the fall period too. So you have all a bunch of factors working against you in the energy sector, which is why I'm not buying the dip right now at all, right? The more favorable period for oil stocks usually starts at the end of January, early February. And that's everything for your minor sector rundown. In terms of yields are not looking too bad at all. Continuation of the daily downtrend that has been started in late November. So looking very good there. And they have recaptured a major level right now, which was this whole 4.56 to 4.5 roughly. Not looking too bad, guys. Weekly uptrend is now denied. Looking for the downtrend shift right here. Well, it's not quite a downtrend. You'd need lower high into lower low, of course. But on the monthly has always been a monthly downtrend, possibly looking for some continuation on the 20 and 10-year yields. What does that mean for your bonds? Well, might be approaching a local bottom for bonds, looking good. Daily uptrend now back in motion for the first time in a very long time. Is your new daily uptrend now above all the short-term moving averages on the weekly as well. Weekly somewhat of an engulfing move. We'll see, can they get the weekly lift right now? Weekly MACD is looking good for a possible cross in the next few weeks. Could this be the bottom of TLT? Possibly, guys, but yields, they're not going to straight shot to the downside, right? It might be a bumpy path down back to 4%, which means that TLT, if we do have contracts in this, it may be a longer road than anticipated. So if you're all looking to play the long side on this, just give yourself a long enough time horizon because these yields can move quite slower than you would expect, right? So that's everything for yields. Now, moving on to Bitcoin, of course. So give me a very brief moment because I've been talking a lot. And now let's get into crypto a little bit. So Bitcoin ending the day very nicely. I mean, the percentage gains here are not the true ones because the candle ended at 7 p.m. and it's about 8:45 right now. All in all, Bitcoin putting in almost a 3% gain on the day. Not much has changed. They've reclaimed the 100,000 level, of course, but all in all, guys, it still remains, right? Nice daily uptrend momentum right now. At this point, any pullback will just be looking for a higher low. Anything above 93.6, higher low for possible further trend continuation right there. Looking very good. And even if you lose this into a daily downtrend, is it that big of a deal, guys? Not really. The weekly's looking very strong. Anything at this point, like look how much space the bulls have created, right? Looking so strong for a weekly higher low. Anything at this point above 65 would be looking for a weekly higher low for further trend continuation. And the big area of support is undoubtedly this one below us, 91K down to about 89K. These guys down here should be providing short-term support. But all in all, Bitcoin is looking quite good. What's looking even better is Ethereum and the rest of the altcoins. Why? Because I've been telling you guys, keep an eye on this Bitcoin dominance chart. Can I even type anymore or what? Bitcoin dominance chart, guys. This is a weekly pattern shift that you have not seen in approximately 2 years. 2 years worth of time. Blasting through all the moving averages right here, coming to the downside. Bitcoin dominance is the percentage that Bitcoin represents as a percentage of total market cap of crypto. Same concept as how much of the S&P does Apple have as a total weight. This is the chart for Bitcoin, and as of right now, Bitcoin has 55% of the whole market cap of crypto is Bitcoin, right? So when this comes down, it does not mean that Bitcoin is going down. It just means that everything else is going up faster. So this chart can go down a few ways. Bitcoin can go down, everything else can go up. Bitcoin can stay flat, everything else can go up. Or Bitcoin can keep going up, but everything else just keeps going up faster, right? That's how that chart works. Clear trend shift. Even if we get a bounce here, looking for a downtrend shift on this one, which is why you've been seeing some clear outperformance in the altcoins. That's how you know the altcoin season is possibly starting. And you may think that things have already ran a lot, but keep in mind, guys, right? When the altcoin season starts, usually you get some pretty decent follow through, right? So that being said, we might be seeing another edition of that. Ethereum cracking above this weekly level. We'll see if they can close this candle on the Sunday. These candle closes on the weekly, right? Looking very strong. The monthly candle does lead us to believe that there will be more continuation, and we have gotten it already. So now smashing through 39 to 38, which was the previous resistance from the May period and the March period as well, clipping into the top end of it, but most of your price action was had between these two levels. Looking very good. Daily uptrend is clear as day right now, looking for a higher low. Anything above 35, looking for a higher low for further trend continuation. Even if we give this up, is it that big of a problem, guys? No. Look how much space we have. Weekly uptrend is very nice. Looking for a weekly higher low. Anything above 2360. Looking for a weekly higher low for possible further trend continuation. If we come down a little bit on ETH, guys, probably looking for this guy right here, maybe 35 as a retest, psychological level there as well. And the rest of the altcoins, I'm not going to go through each one, but just take a look at the Bitcoin dominance chart, guys, and you should have a good idea as to which coins are outperforming the rest. That's not the purpose of this video. I'm just here to explain to you that the altcoin rally is happening right now. Which ones you choose to position in is obviously completely up to you guys, right? So now moving into our big tech names, shall we? Moving into Apple. So Apple looking pretty decent today, even though they're down 0.8%, 0.08%, right? Now, daily overbought conditions on Apple, guys, clipping into this mid 70 region for Apple. And we know that although this company can be overbought, it does not stay overbought for very long. So Apple could be seeing a little bit of a retracement come early next week. If that is the case, might just be unlocking one of my favorite trades on Apple, which is the breakout of a previous area of resistance. This time it's the all-time highs. A breakout, retest, and possibly run. So I'll be looking out for that retest on the possible downswing here. But one thing is for sure, anything above 222, 223, this is one single move. Looking for a higher low for further trend continuation. So I'll be sitting here. If we come back down into here, maybe looking for some short put opportunities in this lower level there, but looking for the breakout, retest, and possibly run. Not looking too bad. Daily bulls, full control. Weekly bulls as well. Full weekly uptrend control right now. Clear break of the all-time highs looking very good. So even if you do forfeit this daily uptrend into a daily downtrend, well, you'll know that on the weekly, we have tons of space. Anything above 219, weekly, higher low for further trend continuation. Apple is a hold for me. I'm not buying any more up here. It has a very high valuation with somewhat questionable revenue growth. That being said, Apple is Apple at the end of the day, right? I'm not selling any of my shares, but I'm not adding any more up here. And I am being very cautious with my swing trades as well. Moving on to AMD. Well, AMD, right, 1.96% to the downside. I don't know if I don't know if the article is here, guys, but towards the end of the day, I can't find it right here. Let me see if I can find it very, very quickly. I don't want to spend too much time on this. AMD, let's see if we can find the AMD. Yeah, there you go. Here it is right there, right? So Amazon, oh, they're going to do that to me. So they're going to paywall me. But anyways, Amazon isn't seeing enough demand for AMD's AI chips to offer them via its cloud. And that's the biggest cloud player of them all, guys. There's nobody bigger than AWS. And if they're saying that, it's not very good look for AMD, right? So the thesis coming under question right now, they were stipulating that they're supposed to expand very, very nicely in terms of EPS expansion. That's the thesis, right? And very nice revenue expansion because of the data center applications. But if there's not enough demand, people might have to review their forecast down. We'll see what the company has to say in Q1 and what their guidance is going to be. The valuation right now does give us some wiggle room because the valuation is fairly cheap at a 1.17 peg, and they do have possibly a lot of upside. But now you guys know why I've mostly been playing NVIDIA, TSM, and AVGO, right? Because there's no questions around their businesses. There's no questions around the demand or the cyclicality of the business either. That's why I'm playing the top names, because we're not seeing broad market semiconductor performance right now. That being said, AMD is still trying to reset into a daily uptrend right now. They had the daily downtrend for a very long time, engulfing move, but with this headline today, AMD was doing fine before that headline came out, guys. It came out right here. You can clearly see when it came out, right? They were doing okay, not the best, but they did come down after that. I'll give them the benefit of the doubt, trying to go for the daily higher lows for the daily trend change, but if not, give back too much of this move, retest or even lower is highly likely. Why? Because we've given up all of the weekly momentum as well. The long-term bulls are not at our backs right now. It is a monthly downtrend. It is a weekly as well, loss of all momentum, and the daily is not yet in an uptrend. So you're fighting against all trends right now. That being said, we are in an area of support, 141 down to 125. Wouldn't be opposed to playing short puts on this company, but you need to give me a very, very good deal if I'm to play this company instead of NVIDIA for roughly the same price, right? Because NVIDIA is also around $140, $138. I'd much rather spend that money on NVIDIA than on AMD right now. That's just me personally, because there's no questions around NVIDIA's demand or NVIDIA's business right now. That being said, AMD can be a decent position if you want to take the risk and take the gamble, because the valuation does support that. Moving on to Amazon right now. Amazon up 3 whole %. Massive rally by Amazon. So looking very good right now. And this is just one single daily move. Now, just slightly coming into overbought conditions on the daily, but the 4 hour is kind of tapped out right now. The 1 hour as well is kind of tapped out right now. But keep an eye on the short-term trends, guys. Loss of the hourly trend is required, and loss of the 12 EMA as well is required, and then only then you will know that it's due for a daily retracement. But that's okay. Anything above 196, just looking for a daily higher low for further trend continuation. Look at these price targets, guys. Right? You can see it right down here. Fubon has adjusted its price target on Amazon to 260 from 230, right? Because Amazon's focusing right now on the expansion of EPS, the expansion of free cash flow, and favoring shareholder returns. We're already coming up. When you guys might remember when we were back here, or maybe even back here a few short weeks ago, I was saying that my target for 2025, early 2025, was Amazon 220 to 230. We're literally already there. So the price target does make sense. The valuation does support that as well. Now, daily uptrend is clear as day. The weekly is also looking clear as day as well. Very difficult there for me to chase up here. I've been in Amazon, guys, for a while. I was telling people down here about it as well on the channel publicly, and even down here for a back test and run. So we had ample opportunities. Now, if you missed all those opportunities, now is possibly not the time to be chasing, not in overbought conditions on the short-term timeframes. Can it run more? Sure, everything can always run more, but it's not a best trading practice to be chasing things into all-time highs, into short-term overbought conditions. That being said, love the company, very good quality. Moving on to Google right now. Google up 1.25%. So Google starting to come alive a little bit, right? So daily uptrend is nice on Google right now. And even so, any move lower, just going to be looking for a higher low. Anything above 168, looking for a daily higher low to continue attacking. That is if they don't continue pushing, right? If they consolidate, higher low into possible expansion again, but we have not, the job's not done, guys. Anything, we have this resistance area, 180 down to about 175. We're still not through it. Same thing with SMH, right? Need to get through this resistance area, because it's been challenging the bulls a number of times over the most recent 6, 7, 8 months at this point in time. So the weekly uptrend is nice, but need to get that next leg higher. That being said, the company's looking quite good. It's still one of my favorite bets in all of big tech right now. The valuation is ridiculously cheap, and that's for a very clear reason, because of the headline risk from the DOJ, right? Look at the price targets for Google stock right now. Look at the EPS expansion. Look at the revenue expansion. No threats to the business other than the DOJ trying to break them up. But if you ask me for my probabilities of that happening, probably under 2-3% right now. There's always a risk, but I think the risk could be quite small to that. And several analysts do agree, but it's up to you. I'm not here to convince you that the risk is small. You have to analyze that on your own. If you're willing to take the risk on Google for that, or because of that, rather, well, that is your own investment decision. I personally think it looks good, but then again, none of this is financial advice anyways, right? So Google looking very strong. Weekly trend expansion is good. Looking very nice there. No big red flags. And even if we do come down, I'll be shopping for more Google down here, short puts, and possibly more call options as well. And that area, once again, mid 160s, 165 down to about 160 is the target. Moving into Meta right now. So Meta, another 2.5% day for Meta, looking very good. Daily uptrend is super strong right now. Might get a possible actionable trade on Meta. Breakout, retest, and run. It's breakout, retest, guys. Very simple. It's just trend continuation trade, right? Some people call it the trend continuation. Some people call it the breakout retest. I like the breakout retest because it's literally in the name, right? It breaks out of a level, and then it retests the level, use it as support, and then run. So that's the next trade opportunity I'm looking for on Meta. If they do retest, the area is 600 down to about 585 is the mark. Previous resistance, current support. Daily uptrend clear as day right now. The weekly uptrend also, well, not quite a weekly uptrend just yet. Weekly downtrend, yes. Weekly upswing, yes. But the uptrend is a sequence of higher highs, higher lows, and higher highs. That we do not have just yet, but possibly if they allow us a retest of the all-time highs, previous all-time highs, we might just get that weekly uptrend chance on Meta. Looking very, very, very solid right now. Meta should be having a very good 2025 for the stock. Moving on to Microsoft right now. Microsoft, I can finally do it, guys. They finally closed a weekly candle above our big resistance area. We've been talking about this resistance zone for how long now? 3-4 months, always getting rejected. Now they finally closed above it. And when I said as well, when you break a big region that's been hindering the stock, I know it broke above here, but if you calculate the amount of time it's spent between these ranges, this is one big massive accumulation zone. Usually when you get a break out of the accumulation zone with a weekly MACD cross of the last 6 months of bearish or negative momentum, and now you got a MACD cross on the weekly time frame, usually it's synonymous with trend expansion, and I do believe we're going possibly for the all-time high extension here up to the 460s. Usually when you get a break of a very long trend or a very long sideways range, usually the break happens and it happens quite hard and quite fast. Pause. Anyways, moving on. The daily uptrend is nice, and I can finally change this box to green because they finally closed a weekly candle, not a daily candle, a weekly candle above it. And that's the only time you'll see me ever close these boxes green or red. So that being said, daily uptrend is very nice right now. Daily uptrend looking for a daily higher low on any consolidation, anything above 418, higher low for further trend continuation. And this again is a breakout retest opportunity trade. If we retest this box, could be an entry opportunity for a little bit of further riding Microsoft up to the all-time highs potentially, right? Retest down back into here, 430. Stop loss goes below here, 418. That is $12 worth of risk, and you're in at roughly 430, and you're targeting the all-time highs at about 460. So $30 worth of gain, roughly $15-ish worth of risk, 2-to-1 risk reward on Microsoft. Seems like a fairly decent trade opportunity to me, but then again, not financial advice, of course. And on the weekly, well, clear weekly uptrend recapture by the bulls and crossing MACD. So do with that what you will. Looking very good in my opinion. Moving into Netflix right now. I mean, Netflix, this is the new Palantir, right? Netflix, very, very, very strong move on Netflix right now. Looking very good. Nothing bad to say about them. Daily uptrend is clear as day right now. Any pullback looking for a higher low, anything above 859, looking for the daily higher low for further trend continuation. And I said, if this continues expanding, take a look at the 950 psychological as the next stop. We will keep a close eye on this pattern. If we roll over into a daily downtrend, you guys know the drill, right? Looking for a weekly higher low. At this point, anything above 745, looking for that weekly higher low for further trend continuation. The weekly right now, though, guys, very, very overbought on Netflix. So in my opinion, there's no risk to reward up here. Right now, this is just an educated gamble if you were to buy the top right here, right? I'm much more partial to waiting for a pullback. That is just my style. If you want to just play for the continuation, who am I to stop you? It's your money to free to do what you're free to do what you want. But in my opinion, the risk reward not that favorable up here. That being said, Netflix is a fantastic company, and I do believe that they will have a very nice 2025. But a lot of growth has happened in the last 3-4 weeks of time. Moving into NVIDIA right now. So NVIDIA is struggling. Why? Oh, you're not going to believe this one, guys. You're not going to believe this one. Wait, can I find it? Here we go again. NVIDIA faces EU antitrust scrutiny as bundling practices come under fire. They are saying that not only that they're saying that they're obliging people to accept NVIDIA's network hardware and software as part of the AI GPUs that they're doing for data centers as well, right? I mean, can you really run the NVIDIA GPUs without the network, the cables, etc., right? And the software as well? It's arguable, right? You know, like when you go to McDonald's, you can buy a burger on its own, but usually you get a burger with fries and a drink, right? So it's a little bit of a reach for the EU, but then again, the EU and the DOJ are known for reaching, that's for sure, right? So once again, DOJ, EU investigations, and the stock unfortunately is down about 1.81% off that news. You guys can see when the headline hit. Early in the morning, because before then it was doing quite fine. So 1.81% to the downside. Now, daily downtrend was in motion. The bulls had a very nice move, but we were always looking for a lower high and possibly looking into see if the bulls, can they reset into a daily uptrend, or will we just roll this over? Now, I'll give you guys the worst case scenario. If they roll this over, we're coming into 130 to 125, decent little area. Why? It's the breakout retest zone. Retest of prior all-time highs on a weekly retest could be looking very good for some further trend expansion. So I will be sitting here with some contracts to possibly buy the dip on this. And even if we come a little bit lower, guys, down into the 120, 119, that is going to be some very good value on NVIDIA, guys. Usually when you get a 20, 25% decline from the highs on NVIDIA, usually it's a very decent buying opportunity. At least the last 4, 5, 6 times it's happened, it has been. So I will be playing off of these two levels. I still think NVIDIA is very strong, poised to have a very good 2025. And the valuation, as a matter of fact, is not as bad as you think. At 142 right now, it's only about a 1.94 peg. It's really not that bad, right? So NVIDIA not looking too bad. I will continue to buy the dips on this company. If it comes down to 130, 125, I may even throw some longer dated calls at it. Moving into Tesla right now. Tesla, rocket ship, really coming alive in the last roughly hour of the day, right? I mean, they had a good start to the morning. They were always up about 2.5%, 3%, really coming alive into the end of the day here, guys. So looking very strong on Tesla. And this was to be expected after yesterday, right? I was saying when you break the tightening range to the upside, right? Some people can call this, you know, a bull flag formation type of thing. This is true. But the way that I showed you guys to do it, if you don't want to take a look at the bull flag, you have to understand the logic. What is a bull flag, right? A bull flag is after a very large move to the upside, a very large move. Where do you see the sideways consolidation? Right? Does the move go very, very high and pull back 50% and then consolidate? Because that's not very good, right? The bulls gave back half their move and now they're figuring out what to do. If they give back 80% of the move and then consolidate down here, you think they have a good chance of rallying or you think they have a good chance of flushing? Probably the flush, right? But if you have a huge move and consolidate for 2 weeks at the top end of a move, the bulls do not want to give back more than they have to, right? They want to stay as close as possible to where? To the area that they're looking to challenge, which is the all-time highs, 380 up to about 405. Looking very good, getting the trend expansion. And I was saying, with the break above yesterday, right? New daily uptrend in force right now. And I would not be surprised if they can push right into the area of resistance. And they're doing it right now. Final area of resistance, 410. And then it is price discovery. That is the all-time highs for Tesla. So congratulations to the bulls. Very, very solid chart right here. There's a little bit of a breakout retest trade to be had if we retest the lower area, breakout, retest, and possibly run, right? Stop loss would go below the lows down here about 330, and you're looking for the expansion with the psychological levels beyond the all-time highs. Not looking too bad, guys. Not looking too bad at all, but still, I mean, you can't really think that you're early into this trade. Is it possible you get some further expansion? Is it possible you go all the way to 500 by next year? Absolutely, but do not think you're early into this trade, right? You're more late than early, and there is some downside risk in that respect, right? it's not as if Tesla has 2x their demand since this run. This has been largely a byproduct of the results of the election. That's not to get it twisted, right? Which is very good for Tesla, of course, for policies, right? For the robo-taxis, but let's not get it twisted, right? This move has not come from an improvement in fundamentals. It's coming from people being bullish on robo-taxis, which per Elon's guidance will only really come, the scale at least, come 2026. They'll start rolling them out in 25, but 2026 is when you start to come into economies of scale. Starting to. Moving on to Palantir right now, the stock that just never goes down, 6.22%. Very nice day on Palantir, 6.22%, guys, but do not get too greedy on Palantir, guys. I keep bringing this up, and I know I sound like an overprotective parent. I know you guys just want to ride this one to the moon. You guys want to ride this to 100, 150, but you have to understand what's happening here, right? This is only hype. This is only momentum. The stock is long since decoupled from its fundamentals. We went through their earnings. Their earnings were fantastic, but they're not this fantastic. And take it from me, guys. I'm a Palantir shareholder. My cost is down here, $11.80. I'm up a lot. Don't worry about me. I'm in. I'm up a lot. But I have cut not half of my position, but I cut a decent amount of my position, probably about 35% of my position. Down the way over here, covered calls, I rolled them up here, and the final exit was around 55. I'm in with a decent amount of shares, but now's the time, covered calls, I still think that is the plan, guys. The PEG ratio is a 7.69, and they have an EPS growth rate, a fantastic 26. Even if you double this, which they're not, this is Palantir's own guidance, they're not doubling EPS growth rate. Even if you were to double this, the PEG only goes down by half. It'll still be, guys, it'll still be like a 3.8 PEG. That's way, way, way too high. Way too high. The price to sales at 76 is at 49.5. That is extreme. Usually tech trades at a 10 to 1, and 10 to 1 is roughly rich. Price to sales. This is a 50, guys. And you might say, yeah, but it's having its NVIDIA story. Not really, guys. The market cap is 174 billion right now. Not really. You cannot compare this to NVIDIA, guys. The revenue is too small. The EPS expansion is too small. Look at this EPS expansion, right? Year over year from 23 over to 2026. Only a double in EPS expansion. Only a double, right? On EPS. Take a look at the revenue expansion since 2022. Only a double. Slightly better than a double, right? You cannot say this is comparable to NVIDIA. Not even close. Look at NVIDIA, 2022, 23. Look at 2022. It is a 10x in revenue by 2026. 10x. That's largely different, right? Not a 2x. It's a 10x. Their growth rate on revenue was far superior. NVIDIA's PEG, while it was growing like this, never truly exceeded a 3 PEG, let alone a 4, 5, 6, or 7, right? Look at the EPS, depending from where you measure, right? This also, depending from where you measure. If you measure from 2022, this is more than a 10x. It's almost a 20x. If you measure from 2023, it's still a 5x, right? Almost a 5x. Not the same thing at all, guys. Not even close. NVIDIA was growing way, way, way faster than Palantir's fundamentals are growing right now. We covered their earnings. Expanding commercial is great. Government contracts are great. Profit margin expansion is great. But keep in mind, guys, NVIDIA was outpacing on all three metrics, and NVIDIA had much better profit margins as well. So please keep that in mind when you're deriving a comparison between Palantir and NVIDIA. It is not the same thing at all. You're comparing an apple to an orange. The only thing that's similar is the chart. That's the only thing that's similar, is the expansion of the stock price, but it's not because of the same fundamental reasons between the two. So that being said, I don't want to sound too bearish here. I'm in. Don't worry about me, guys. I'm in, right? So I have the right to talk about this way. At least I think I do. So daily uptrend is clear as day right now. If you want to play this one, just play the chart. Only play that, just forget the fundamentals, because right now it is long since decoupled from the fundamentals. So forget about the fundamentals. If you're holding this long term, it could be interesting to trim some profits here, because we're pricing in growth all the way to 2030 right now and beyond. Could be interesting to possibly trim some profits, write some covered calls, do what you have to do, but do not get too greedy, guys. I know it can possibly run more, but one thing's for sure, do not get too greedy. Now, moving on to the actual technicals right now, it's not looking too bad, right? Technicals are looking very, very good. Just play the chart. Just play the chart for what it is. Daily uptrend looking good. Any pullbacks looking for a daily higher low. Anything above 59 looking for a daily higher low for possible further trend continuation. Not looking too bad. If we get the daily trend rollover to the downside, looking for a weekly higher low. Anything at that point above 41. A lot of space looking for a weekly higher low for further trend continuation. Weekly RSI is 86, right? 86. Monthly RSI is 87. Daily RSI as well has been overbought now for the past month. So this is starting to be a little bit excessive. I mean, it's been excessive for a while, but now it's starting to be like close to top signal, right? We're really coming into close to a top signal. Can it keep running a little bit more? Yes. Why? Because institutions don't have a lot of this. This is all retail. Retail has 80% of this stock, guys, not the institutions. That's why it's running like this. So keep that in mind. Please, please, please be careful, especially if you're trying to buy the tops up here, guys. I do not want to see anybody with some bad stories. But right now, the market's on easy mode. You just click the buy button on anything and it goes up, right? It's not always the case, guys. Do not build bad trading habits. If you want to make the most of this market, sure, try your hand at it, but just don't go in with a full portfolio. Please, I beg of you. Sometimes it can work, sure, but do not develop the bad habit. So that's pretty much everything for our stock analysis rundown here, guys. I'll do SoFi and all those a little bit at a different time because now we're kind of running a bit short on time. I'll probably do them on the Monday recap or whatnot. But now let's dive into the trades because we've got a lot of trades to review. So let's jump right into that, shall we? All right, so taking a look at a little bit of the trade recap for this week. So we played a few SMCI contracts. You may remember I showed you guys a lot of these trades, so none of these should be new. We played MSTR in a very conservative fashion from last week. 240 puts. We got them for $300. Closed them for $52. This is nothing new to you guys. I played MSTR yesterday, the 312.5 puts. $1.09 is what we got. We closed them for 35 cents just to free up some buying power before the non-farm payrolls jobs reports. Because if the non-farm payrolls would have been bad, guys, it would have been pretty red today, right? Elf Beauty as well, played it a couple times this week, 113s and the 118s. This is one of my top 5 options video, both very decent wins. NVIDIA, we played it a few times as well. One on the weekly puts, 66 cents, and we got them down to about 85% win there as well. On the initial dip on NVIDIA early on the Monday session. This one we took last week. It was a longer dated put. We got the 132 strike on the dip last week, and we got them for $400. We closed those this week at 94. The reason we closed them, guys, is because they're for December 27. Is it worth it for me to hold NVIDIA? We closed them yesterday or something like that. Is it worth it for me? You guys tell me, right? Because you guys are experts at the wheel strategy by now after watching my videos, right? Well, obviously, I hope so now because I talk about this a lot. So bringing forward premium, this is what we call pulling forward premium. When you're happy with the level, you go with the longer dated strike, and on any bounce, the premium comes out of it very, very, very rapidly. So is it worth it for me to hold 94 cents on $13,200 of capital exposure, right? Is it worth it for me to hold just this amount? Oh, I did something wrong there. My bad. 0.94 divided by 132, right? Is it worth it for me for 0.7%? 0.7% for another 3 weeks worth of time, right? Divided by 3. Is it worth it for me to hold 0.25% weekly ROI when my minimum targets are 0.5? It's not worth it for me to hold the exposure, guys. So I cut the trade and you go shopping for something else that is more capital efficient. So moving on, SOXL as well, 27 puts. They expired today, completely worthless. SOXL ending around 29. SMCI, 33 puts for today, expired worthless, another 100% win. I was playing SMCI and SOXL with a lot of room to safety, so that was good as well. And the new, we also played them initially on the dip over the course of the Monday session. I showed you guys this position, right? Monday dip, down here into the high 11s. I went with the $11 strike, which was, for all intents and purposes, the bottom end of this support range down there. I played the 11s a little bit conservative, and I was decently rewarded for them as well. We closed these pretty much almost worthless, right? Very good. Directional trades. You guys remember I had the Microsoft call debit spreads for December, 435 versus 440s, 210 to $2.75, 31% ROI. We held them for a while, guys, on those Microsofts. You might remember we closed one contract when we got the pop back here, and then we closed the second contract several months later, right, with only a few weeks left to expiry. Now, I closed these yesterday. You could say, yeah, but why didn't you wait a little bit more? Because they're for December the 20th, guys, and I just do not want to take the risk. I already have more contracts that I showed you guys. I have some for February as well. They're right here. So I'm not going to hold the Decembers and risk round tripping some of my gains, right? When I have the Februaries as well for the purpose of continuing on with that same trade. So that's the logic behind closing those. We did take a little bit off the square leap calls as well, right? The square leap calls are up tremendously right now, but you don't want to overdo it. You want to just slowly clip them out as your targets get hit. So the $100 call options that we bought when the stock was around 60 364. They're now up a ton, right? We got them for 555. They're up pretty much a 4x right now. So looking very good there right now. So we closed another one this week at $20, just a little bit earlier than where they were today. We closed them at $20. I have 2 contracts remaining. This most recent one was closed for 3.7x. The one just a few short weeks ago, if I can find it, was closed for a 2.7x. We closed the first one at $15 each. So you'll see me slowly clip out as we move into my profit targets, and that's how I like trading these as a whole. And then we did have a few little plays right here. Chewy for the earnings play, that one went very well. My 2 standard deviation times the expected move. And we also had an Uber play. Uber yesterday, I mean, I don't do this very often, but sometimes I do when I find that something is a little bit overdone. I pretty much, for all intents and purposes, picked almost the lows of Uber down here. I can even show you guys the trade alert. It was in the lottery section because it was full falling knife, right? We got them at these ones right here, 3:28 p.m. If I zoom in on the chart, I mean, you can see right here, 3:28 p.m. was, for all intents and purposes, almost at the lows of the day, right? And I sold them literally first thing at the open. Why did I sell them first thing at the open, guys? Well, because the IV spiked a lot. So the call options were fairly juicy, but I knew that if today was a muted day, the IV would drop. And since we broke through a major level right here, 71 to 68, broke through a major level, the expectation is always lower high into possibly lower low. It is somewhat of a falling knife right now. We have no time frames, right? Not the hourly uptrend just yet, not the 4-hour uptrend, definitely not the daily either, right? Full daily flush, and the weekly downtrend is not in our favor as well. So I'm not going to YOLO hold these calls, even if they were for January. It was a quick in and out scalp. I used 1 month worth of time because in the event we would have moved down a little bit further and spent a week down here before getting a pop, I did not want to get destroyed on weekly options. So that's why I went a little bit longer on the time. We bought them for $1.65. We flipped them for $2.40 at 9:37 a.m. So decent little win right there. Not too bad. 45% ROI. And I only went in with 1 small contract because I do have an outstanding position on Uber right now. Let's get into the current trades of the week, shall we? So none of this has changed. We went through a lot of these. Still the AMD bull call debit spreads for February. Amazon, this is a lead call contract as well. It's doing very well right now. We still have the ASML bull call debit spreads for January. We'll see if they hit, but as of right now, we are down money on these. So far, not looking like they will come back, but if we can close these for less of a loss, ASML is not looking bad. I wouldn't be opposed to taking this trade again with maybe more conservative strikes, with maybe a March or April expiry somewhere up here with some call debit spreads, looking for the eventual recapture of the trend, right? So I'll try to do this trade again as per now. End phase, a leap call up, well, leap. The 6-month call options are here, 85 calls. We're up nicely on those. Cost is 763. We're up to 985. So decent gains there as well. I should put the percentage gains on ROI. Sorry about that. EVVTY, my most recent stock purchase, doing well. The Googles, both call options, the shorter term call options for the recovery are doing well. The leaps are doing very well as well. We're up a ton on those. 28 entry, 45 current. Intels, these are back to break even. I will possibly add to the $30 calls right now. 20% down this week because of the CEO news. IWM, we still have these leaps, about 9 months worth of time on these. We're up on these decently, but we're not getting the absolute moonshot that we were looking for, right? So we'll keep those. Coca-Cola, we are down on these already, but we will be making possibly a DCA once they recapture the daily uptrend. I'll let you guys know when that happens. By what I mean by that is I need to see a new daily uptrend, not just a rollover, because the expectation right now is a weekly downtrend. We're always looking for the lower high, and the size of this bounce was very weak. Very, very, very weak bounce on the weekly, 38% bounce. So it stands to argue if you cannot set the daily uptrend and you come all the way, you cannot set it, guys. They did not set the uptrend. I'm waiting for them to give me a daily uptrend, and I'm entering more calls here because then my entire stop loss goes below there. Because if we roll that over, we are going lower, and that's exactly what happened. That's why I did not add here. I did not add here. I wait for the confirmation of the trend. Trend is your friend, right? Now, moving on further, Microsoft bull call debit spreads, we explained those. I'm keeping those towards the all-time high and possibly a bit further. Those are for February, so still some decent expansion. We're up nicely on these. I don't know why it says they're $26 right now, but we're up decently. We're up about $500 on those. 5 contracts cost me about $1,000 total. We're up about 500, so about 50% on those. MSTRs, we went with the 255 short puts for next week. 255, a very large margin of safety, guys. 37%. We got almost 1%, right? Just on about 0.75, 0.8% for these. I'm playing MSTR, but very conservatively. Short put for 255s. Micron, leap calls, we'll keep those. NVIDIA as well. 137 short put for next week. Wheel strategy. If I get a sign there, no problem. You see that we got them pretty much where they are right now. The 137s for next week. I don't mind buying shares there. So we'll see what happens on those. NVOs finally up on our calls. The cost is here. Here's the current running price. Not too bad. Looking for expansion into 120, and then I will close, even though they are for April. Not looking too bad. Was expecting a quicker move, faster, but it's not happening just yet. Oxy, I mean, these are done for. These expire next week. The calls as well. We closed some good profits on the... We had two of these. We closed the first one at about $550, and now we're just riding this one into March. We'll see what happens, but it's not looking too good. Remainder of the position is very, very, very small. Even though we have lost money on the debit spreads, I opened these a while ago, and I was just holding them. They've been worthless for a very long time, but I figured I should just explain. The SMCIs and XOSLs, they expired today above the price. This is what I mean when they expire worthless. We have the SOXL May 25 call for the expansion of the SMH trade. So far, we're still a bit underwater on those, but not looking too bad. Haven't added just one contract, very small. Square leaps, we went over those. TLT hedges, I might be adding to the Junes, but not the Januaries. Januaries, I'll let it ride, see how much recapture value we can get there. I'll probably be adding to the Junes or Decembers. Uber, 66 short put. We got them for 41 cents. When Uber was down that day, down 4% is when I took the trade. They ended up down 10%. Uber's right around 66 now. If we get a sign, I do not mind at 66. My DCA comes in around 60, and I will throw calls at it if it comes into 60. We'll see what we get. And UPS, the 126 puts. Been talking about this one for a while on the channel. 74 cents is what we got. If I move myself over, 74 cents is what we got. They're trading a bit higher right now because we took them earlier on yesterday, I believe, or the day before. We took them up here at 128 when it was looking good. And now they're down and we're already underwater on these, but you guys know the drill, right? We're targeting this overall area. So 125 down to 120 into these guys, into the 200 monthly moving average is where I'm looking for. The valuation of the company is good. It's more of a defensive company, and their fundamentals are turning around. And the monthly, although it can take some time, we're looking for the cross of the monthly MACD after 2 years of downside. It can take some time. I'm willing to buy shares here because I've waited patiently, and I've said if it comes down here, I'll buy. So I'm respecting my own rules. It came down there and I'm buying. So that's a full rundown of the portfolio and everything in between, the earnings, the weekly candles, everything, all the sectors, crypto, Bitcoin, everything together, guys. So that was a very long video, probably one of my longest ones. As you can see, I talk very fast. There's no fluff. I try to get through this as much as I can, but there's just a lot of things to cover, right? So if you enjoyed today's video, despite the length, consider dropping a like. Would appreciate it for the growth of the channel. Also, consider subscribing if you're new. Would love to have you back here. Over 4,000 of you have subscribed so far. Thank you so much for putting me above that milestone. Appreciate all of you guys, and thanks very much again. And lastly, if you have any questions on anything in this video, because there was a lot, always feel free to leave them down below in the comment section. I'll get back to you guys in 24 hours. And in the event you guys want to have access to all of these real-time trades, whether it's the wheel trades, the calls, here's the weekly recaps. This is this week. Last week, the green check marks are wins. The reds are losses. You can see that the losses are fairly few. These are assignments, after which we usually get out of all of them at a profit. I'll just go through my trade since the inception of the Discord because I have nothing to hide. I show all my portfolios, right? So this is all the trade list. Past performance is not guaranteed for future results. None of this is financial advice. These are just examples, right? So if you guys want access to all of these trades, the link to the Discord is down below, of course. And it doesn't come with just the trades, right? Calls, short put options, long-term portfolio, everything in between, call debit spreads, private morning live streams, Monday through Friday, 1 hour to 2 hours, all of my trade ideas and setups, and talk to me all throughout the day. We have some juicy private videos as well that are not on YouTube, in terms of strategy, how to run leaps, how to run call debit spreads, etc. All the tutorial videos that people want. And then obviously all throughout the day, you can ask me questions on your stocks, your options, and everything in between. So if that's a service that interests you, the link is always down below in the description. So feel free if that's something that interests you. And if not, well, I guess I'll see you back on the channel, guys. So take care, have a great weekend, and I will see you tomorrow. Tomorrow or Sunday, the top 5 options video will be coming out as well. I'll try to see if I have the time to do a thematic video for this upcoming Saturday, guys. But I have a very tight schedule tomorrow for Saturday because I'll be in New York for the Monday through Monday, Sunday, Monday, and Tuesday. So I will possibly be doing the videos on the YouTube channel Monday and Tuesday night. Monday might be a little bit busy, but I am back Tuesday. So I'll try to do it late Tuesday night, if anything. But top 5 options, I'll schedule it for Sunday throughout the day. So no missing out on that. So see you guys soon, guys. Hopefully you enjoyed the video. Take care. Enjoy the weekend. Rest and relax. And hope you had a great week in the markets. Take care and peace. That's it for me.